Hello financial professionals, Charlie Gipple here with CG Financial Group with another demystifying explainer video. Remember, simplified down parts of these videos we can rebrand for you at CG Financial Group for use with your clients. Now this video today is on comparing taxed tomorrow money versus taxed today money because there are a lot of misperceptions. So let's just jump right in. Whether you're putting money into a taxed tomorrow account or a taxed today account, the goal is the same. As in, you put in this amount of money and you get back that amount of money later on. That's taxed tomorrow. On the tax today, it's the same. You put in that amount of money and you get out this amount of money later on. The goal to accumulating wealth is to put in less than what you get out. But that's where the similarities end. So let's compare and contrast from a tax treatment standpoint. On the left-hand side, the reason people like traditional IRAs or traditional 401k plans so much is that money that they put in has not been taxed yet. It's excluded from income in that given year. Conversely, on the right-hand side, with the taxed today money, well, as the name implies, that money has been taxed. But the thing is over on the left-hand side, 20 years, 30 years from now, that money that comes out, that is 100% taxable, whereas on the right-hand side, it is not taxed at that point in time, so there's a trade-off there. As I like to say when comparing and contrasting these two for clients, Mrs. Client, had you rather pay taxes on the seed or had you rather pay taxes on the harvest? Because on the right-hand side, you are paying taxes on the seed. On the left-hand side, you are paying taxes on the harvest. Now, that's a very simplified statement to make, and I go on to further explain the math around this. I also explain how the indecision of whether they go the right-hand side, the tax today money, which is Roth IRA type money, which is also cash value life insurance money, or the left-hand side, traditional IRAs, traditional 401ks, largely depends on what they believe their tax rate will be at retirement versus what their tax rate is today. Let's explain. In explaining, we're going to use an example and some really simplified math here. Now, let's say that our consumer has a job, and in that job, that person makes, $10,000 a year. Let's just simplify this. And with that $10,000 per year, that consumer wants to put money into a traditional IRA. Now, the beauty is that $10,000 with a tax tomorrow account, which is a traditional IRA, that whole $10,000 can go into that traditional IRA. Because it's not taxed yet, right? And then what does that traditional IRA grow to, today being $10,000? Well, assuming a 20-year period of time and a 5% interest assumption, not guaranteed, that $10,000 will grow to $26,532. So when our consumer wants to retire, how much can he or she take out? Not $26,532. The net amount of retirement income depends on our individual's tax rate, right? That is what his tax rate is 20 years into the future when he wants to retire. So let's go to our assumptions. Our assumptions are today, the tax today rate is 35%. Which is irrelevant for this part of the conversation, but the tax tomorrow rate is also 35%. So we're going to assume parity, today's rate versus tomorrow's rate. Now, how much is it then that he can take from his retirement portfolio, which pre-tax is $26,532? Well, after netting it out with a 35% tax rate, that comes to $17,246. Now, how does that compare to the taxed today scenario? So if he made $10,000, then that means that he is taxed on, well, the taxed today rate, right? Which means that he only has $6,500 to put into this Roth IRA. Or if he wants to do cash value life insurance, which we at CG Financial Group do a lot of, then it's $6,500. Now, what does that $6,500 grow to over the next 20-year period of time based off our 5% assumption? Mathematically, it comes out to be the exact same as what he netted on the other side. It comes out to be $17,246. Now, this is no coincidence. This is mathematics, right? On the left-hand side, where you take $10,000, let it grow by 5%, then deduct 35%, it comes out as the exact same as deducting 35% and letting it grow by 5%. In other words, the main determinant of if the client goes with the left-hand side or the right-hand side should be what he or she believes tax rates are going to be in the future versus where tax rates are today. Because if he or she believes tax rates in the future are going to be higher than where they are today, one should probably look at the right-hand side, cash value life insurance, Roth IRAs. For instance, let's get rid of our 35% assumption for the tax rate tomorrow, 20 years from now. Let's say that instead tax rates have increased. And we at CG Financial Group have a piece on how likely it is that tax rates will increase. But heck, let's be conservative and say we expect them to increase only to 40% for our hypothetical client. Well, that gets rid of our $17,246 assumption, right? What that means is the new math with a 40% tax on the harvest 20 years from now, our client's $26,532 gross is only going to generate $15,919, which is less than what would have been generated after tax on the right-hand side. So, if you want to have the conversation with your consumers around this, again, what we can do is we can rebrand this in about a 2-minute video, as well as provide you with a tool that helps you explain in a compelling manner what tax rates will likely do, no guarantees of course, in the future when that client starts to harvest what they planted 20 or 30 years ago. Again, my name is Charlie Gipple, the founder and CEO of CG Financial Group. If you are a financial professional that does life insurance, annuities, or asset-based long-term care, please give us a call at 515-986-3065, or you can visit our website at cgfinancialgroupllc.com, and down at the bottom, subscribe for updates, where we give you sales ideas as well as product updates on an ongoing basis, or you can email us at info@cgfinancialgroupllc.com. Again, CG Financial Group is a marketing organization based out of Johnston, Iowa. We are not tax professionals, and understand that much of our illustration here is simplified for greater understanding.